Corporate finance practice problem using OneNote. Acquisition and coefficient of variation. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're on the icon on the left-hand side in the Practice Problems tab down in the 2021 Acquisition and Coefficient of Variation tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations down below, and to the right, we're looking at an acquisition type of situation. One company thinking about acquiring another, focusing in on the impact for the earnings per share and the volatility with regards to the earnings per share. We're going to be calculating the coefficient of variation, which is often a calculation used to consider the risk that will be involved. It's kind of a statistical type of tool. Note that we do have a section in a prior section where we go into these kind of statistical tools. So if you want to focus in on them in more detail, you could go back there. We're going to be using this tool to then apply it in this particular condition where we have this acquisition possibly taking place. So the information, we're going to assume A company is thinking of buying B company. The expected earnings per share for A, whether there's a merger or not, we're going to say the earnings per share are going to be remaining the same at 7. So the standard deviation of the earnings, if there is a merger, goes from 2.9 to 1.9. So in other words, the expected earnings, we're going to say it's 7. From a statistical kind of standpoint, we're basically saying that's kind of like the average or the mean. And then we want to think about the variation from that point, which would give us an idea of kind of like the volatility or the risk that would be involved. So you're imagining from a statistical standpoint that that's kind of the middle, and how spread out would the data then be, from that middle point. The more spread out the data would be, then the more likely that there's going to be risk, or the more likely it's going to deviate from that center point, possibly resulting in risk. And that's what we're looking at with the coefficient of variation. Often a term that's going to be useful if we're comparing from one thing to the other with the coefficient of variation. So that's what we have here. So we're going to say that the standard deviation, that's also, of course, a statistical type of calculation. You can go back to that prior section where we focus in on those types of calculations a bit more if you want to take a look at that. We'll have another problem that focuses in on the standard deviation in a bit more detail. But if we have the standard deviation of the earnings, if the merger goes through or not, this is what we start with. This is because the companies are negatively correlated. So in other words, the standard deviation, which again measures kind of like the spread of the data, went from 2.9 if we have no merger to 1.9 if we have the merger. So it's going to go down if we have the merger. Why would that be the case? That means that there's going to be less spread and less risk, you would then think, if the merger takes place. Now, if the merger takes place, we can kind of think of the merger as being a merger that's going to be something that's going to be in the same kind of industry, for example. And if they're in the same industry, then that could accelerate our good times because we know what we're doing in that industry and we'll go up there. But if the economy is bad for us, or the times of year when the business cycle is low for us, then it's going to also heighten those dips that we're going to have as well. Whereas if we have a negatively correlated industry that they're going to be merging with, then possibly the negatively correlated industry is going to be strong where the other company is weak. So if the economy takes a dip, then you would expect then the other company to do well versus the two companies to be opposite on the extremes there, kind of like a diversified portfolio. So there's pros and cons to either of those kind of methods. A whole lot of thought can go into those two, but that's going to be the general idea. So we're going to say this merger was negatively correlated, and that would mean the risk would go down, standard deviation going down, the coefficient of variation you would expect to go down as well. The coefficient of variation can be calculated. This is going to be before the merger takes place at the 2.9 standard deviation, and then we have the 7, which is the expected value, kind of like the mean or the average in our calculations. And that will give us the coefficient of variation, which is going to be the 2.9 divided by 7, the 0.41. And that doesn't make us like a lot of sense in and of itself, but when we compare it to something else, then that's when it's going to be useful. That's when the coefficient of variation is useful. That's why we use it oftentimes. So if we take a look at the second one, after we have the 1.9 on the standard deviation, and then we have the expected value at the 7. So if we divide that out, then we've got the 1.9 divided by the 7. We get to the 0.27. So the point being then that the second one is lower, which would result in us believing that it's got less spread that would be involved from the data, and that would be an indication that there would be less risk involved, which is typically going to be a good thing if, in other words, we have the same expected return for the shareholders and the risk goes down, most investors being risk averse, then you would think that the market price might actually go up, increasing possibly the price to earnings ratio, meaning the price being higher with relation to the earnings per share generally. So in other words, because the expected earnings after merger are less risky, a risk-averse investor might be willing to assign a higher PE ratio value to the earnings, meaning basically the market price might go up in essence compared to the same earnings amount, which is still at the 7 at the earnings per share, given the fact that there's less risk. So we'll see another practice problem that'll focus a little bit more in on the statistical kind of analysis in this context. Again, take a look at a prior section if you want to look at these statistical kind of components in more depth.